Retail options trading often centers on probabilistic forecasts, effectively treating contracts like lottery tickets for an unknown future. The Black-Scholes-Merton model, however, functions as a deterministic mechanical ledger for synthetic replication. When Myron Scholes and Fisher Black first approached options pricing, they were not attempting to predict the direction of the market. They were looking for a way to eliminate directional risk entirely. Robert Merton later proved that an options value is not derived from a gamble. It is a specific leveraging system that can be replicated using a precisely managed combination of stocks and cash. This is the Black-Scholes-Merton equation. It serves as a rigid balance sheet, dividing the value of a call option into two distinct columns, a set of assets and a set of liabilities. The left side, S0 and D1, represents the exact quantity of underlying equity required to replicate the option sensitivity at any given moment. The right side identifies the liability. To acquire that equity, the replicator must borrow cash from interbank money markets, represented by the discounted strike price, K. In a typical $10 call, the market maker might hold $60 in stock against $50 of borrowed cash. The $10 you pay is the exact cost of establishing this hedged position. This means the premium is not a price in the traditional sense, but the present moment cost of maintaining a dynamically managed margin account. Because the buyer's premium only covers a small portion of the equity position, the market maker relies on external interbank capital to fund the remainder. Borrowing this capital from the interbank market incurs continuous interest charges, creating a daily financial drain on the replicator's position. This drain is measured by theta. It reflects the literal interest paid on borrowed cash, plus the friction costs of rebalancing the stock portfolio to maintain a neutral hedge. On this chart, we see how theta decay accelerates as time, t, approaches zero. As the window for a market move closes, the interest and maintenance costs begin to consume the remaining value of the synthetic position. Theta represents the daily rent extracted by the market maker for fronting the capital required to sustain your leverage. Visualize this on a 2D plane. The upward curving line is a long option's nonlinear value. The tangent line slope is delta, the exact stock needed to offset price movement. As price moves, this slope changes. This acceleration of delta is gamma. This convex geometry ensures that all long option positions, whether calls or puts, carry positive gamma. Positive gamma creates a self-adjusting leverage effect. When the price moves favorably, delta increases and the position becomes heavier. When it moves unfavorably, delta shrinks, lightening the exposure. By contrast, the underlying stock is represented by a perfectly straight line. Its slope never changes, regardless of price movement, meaning its gamma is exactly zero. Because stocks are linear, derivatives serve as the primary mechanism through which nonlinear, accelerating risks are introduced to the financial system. Institutional desks often hold thousands of different assets. To manage risk, they must find a way to sum the sensitivities of tech stocks, energy ETFs, and consumer goods options into a single value. Industry standards rely on beta-weighted delta. This calculation translates disparate risks into a unified mathematical language. By adjusting each asset for its price and historical correlation, a diverse portfolio is converted into a single SPY equivalent exposure. For example, the negative delta of a long put option can be used to neutralize the positive beta-weighted delta of an entire stock portfolio. While beta-weighted delta shows directional exposure at a single moment, gamma determines how quickly that exposure will shift when the market moves. Modern markets are defined by a structural imbalance. Institutional and retail investors are constant buyers of downside insurance and sellers of upside yield. As the counterparties to these trades, market makers are structurally forced into net short options positions, creating a negative gamma environment. In this state, a dealer's delta moves in the same direction as the market. As prices fall, their delta becomes more positive, forcing them to sell the underlying asset to remain neutral. This threshold is the gamma flip point. Above it, dealer hedging stabilizes the market. Below it, hedging amplifies the trend. Breaking this level triggers a feedback loop. Falling prices force dealer selling, consuming liquidity and driving prices even lower. The execution of these non-discretionary hedging algorithms can transform minor sell-offs into violent, self-reinforcing market crashes. The volatility event in the South Korean EWI ETF on March 13, 2026, provides a case study of these mechanics in a live environment. Data from that period shows a 10-to-1 put-to-call ratio. This created a massive cluster of negative gamma exposure, totaling nearly $28 million, acting as a visual gravity well for the price. Unlike a short squeeze, which is driven by margin-driven human panic, a gamma squeeze is a mathematically forced algorithmic execution that proceeds without human intervention. To maintain hedges during a cascade, market makers require immediate, substantial access to interbank liquidity. This requirement links the micro-hedging of individual options to the macro liquidity backstop provided by the Federal Reserve. If interbank lending ceases, evidenced by a spike in the TED spread or a drop in reserve balances, a localized gamma squeeze can quickly escalate into a systemic collapse. Ultimately, the Black-Scholes-Merton equation provides the essential mathematical framework for predicting and understanding the sheer scale of these modern liquidity crises.